Right, welcome back from lunchtime, everybody. Appreciate you being here. Thanks to the STM team, as always, for an amazing conference. Round 2 last year's in Miami was awesome. Here we got the Big Apple. Congrats to the STM team also on their new platform launch yesterday. Amazing stuff. We got a very hot topic in the crypto, the real-world asset space today. Right here with the gentleman on my right, we got on-chain lending and private credit markets. Private credit specifically is just a hot asset class in finance broadly, and doing this on-chain with some of the pioneers here has been amazing. So I want to take a chance to introduce everybody, and maybe Sid, if you want to start, a little background on yourself, brief on Maple, and then we'll come down the line.
Yeah, perfect. So very glad to be here. My name's Sid Powell. I'm the CEO and co-founder of Maple Finance. So for those who don't know us, we are an on-chain lending and credit-focused asset manager. So we will do over-collateralized loans to institutional borrowers. So think trading firms, exchanges, OTC desks, high net worths, and family offices. On the other side of that is, of course, a yield product. So people use us to get a yield on either stables or more recently, Bitcoin yield product, which is run through staking. So we've been around for about 5 years. We have just over $1 billion in assets under management, and we've done about $7 billion in loans to date to these instos. So very happy to be here. I'll pass it on.
Hey everyone, I'm John. I lead institutional partnerships for Centrifuge. Centrifuge is a tokenization platform. I've been around for about 4 or 5 years now. I've tokenized close to $1 billion worth of assets, mainly in the private credit, real estate, and now tokenized treasury space. And then last year, we launched an asset management arm of our business, Anemoy. We've partnered with Janus Henderson. They manage close to 400 billion assets under management, large traditional in the space. And we've launched a tokenized treasury fund with them.
Last but not least, hi, I'm Anthony Moro, the CEO of Providence Blockchain Labs. Where to begin? ProvLabs is a software development company, blockchain development company that helps asset issuers fast follow the largest builder on the Providence blockchain, a firm by the name of Figure Technologies and Figure Markets, run by a guy named Mike Cagney. Really, Mike has built the largest private credit business on any blockchain, really the largest real-world asset business on any blockchain anywhere, public layer 1 blockchain anywhere, with the only disrupted asset class, which is home equity line of credit. To date, they've done about $40 billion of HELOCs on Providence. And they've got about $10 billion locked right now, according to RWA XYZ, and they're adding $600 to $700 million per month. And it's Figure Technologies plus 140 other originators using the tech stack, and it's not really doesn't have anything to do with crypto. It's not, if you go to figure.com and take out a home equity line of credit, you don't see the words crypto or blockchain anywhere. It's really an efficiency play. It makes the process of origination to warehouse to securitization significantly cheaper than its TradFi comparison. And it really is the big success in most blockchain use cases, and certainly in private credit. And I think it serves as an example of how other asset classes can come on chain by being just cheaper, faster, and safer than their TradFi counterparts. And my mantra, my formula is cheaper, faster, safer, plus. The plus is also what can you do with these assets? Can you put them in a lending pool? Can you put them in a vault? Can you sell them individually and tokenize them? So cheaper, faster, safer, plus. You'll hear me say this over and over again. This is what our process does, and this is what I'm sure we'll talk about with the innovations that are coming from Maple and Centrifuge as well.
Awesome, thank you guys. And I am Peter Gaffney, Director of DeFi and Digital Trading at Inveniam. I was actually with the Security Token Advisors and Security Token Market team that put this event on for the past few years. Since 2021, really cut my teeth on the advisory side, helping build up our research, and just got obsessed with tokenization back then. We have tens of billions of dollars of commercial real estate and private credit data flowing through our pipes, which we credential on different blockchains at Inveniam, and my personal thesis is we'll use that to drive a lot of performance data and ZK-proof metrics into DeFi applications, so these off-chain assets could actually come in and have some meaningful, activities within DeFi currently. So speaking of, and I know we got some different blends, we have crypto-backed loans, we have crypto yields, we have off-chain asset yields in crypto with this panel up here. But let's just say, guys, what is the state of the DeFi lending market? crypto lending right now. There's been a lot of reports come out. Sid Maple just passed $1 billion. Centrifuge, you guys are crushing it with the ERC 7540 protocol, the HELOCs, Anthony. But each of you, why don't you take a minute and just what is your breakdown of the space?
A couple of days ago, Galaxy released a really interesting report on the overall state and structure of the crypto lending market. I think one of the key callouts is it's still much smaller than it was in 2022. So if you look at the major players who are participating in 2022, Celsius, BlockFi, Genesis, all of these players are gone, but in their place, we've had Tether is now the largest lender against crypto in the market today. And then we have increasing market share being taken by DeFi, which is also another interesting change from what the market looked like 3 years ago, where it was very much dominated by CeFi lenders. I'd say, so the space is overall relatively under-levered versus what it was, so I don't think there's a ton of systemic risks. There is less inter-lending between parties now. So if you look at the state of lending back then, you had Alameda and FTX were both lending and borrowing from Celsius, Genesis, and BlockFi, so it was very interconnected. And then when one of those dominoes started to fall, it took down multiple parties with it. Whereas I would say the lending businesses today are much more segregated and kind of self-contained. And so I think we have overall less leverage, less risk built into the system than we did before, and there's also far less under-collateralized lending or unsecured lending taking place today. Most of the lending done today is going to be backed by Bitcoin or other large cap collateral. But what we have seen that's an interesting opportunity is more interest from traditional financial players like Cantor Fitzgerald, who had announced that they want to enter the Bitcoin-backed lending space. And so we're seeing more entry of these traditional players who have not historically had much to do with crypto or on-chain lending businesses. So I'd say there's a number of opportunities starting to come through now.
Yeah, I agree with that. I think I'll stick a little bit to the RWA side of things, but I think when you look at the platforms, private credit on chain has been around for years now, and I think we find really cool things to do with this technology, but then don't really think about the consequences of it. And so you saw a lot of adverse selection early on, and now you've seen sort of a consolidation of marketplaces that are bringing truly knowledgeable experts in-house to vet this credit, like I know Maple is doing. And then you have other platforms that are partnering with asset managers that know what they're doing and that have experience in this space. So I think that's on the platform side. On the issuer side, you obviously have Apollo, you have KKR, you have Hamilton Lane, you have all of these very well-known parties that are trying to come on chain, but it's sort of strictly from a distribution perspective, at least for the most part. We have an onboard submission page, we have a submission page on our website, and we have these private credit shops, private equity shops sort of submitting all the time, but it's all about distribution. And I think we're still trying to find the use case there, and I know Anthony and Provenance are doing a lot with the figure business here, but yeah, we're still trying to find that kind of operational efficiency use case on the issuer side.
I'll take the baton from that. I think the holy grail that we all want to work towards is a marketplace where you can hold Bitcoin, public equity, debt securities, ETFs, all sorts of alternative assets as well, and have one wallet that enables cross-collateralization among different assets, borrowing and lending against each assets. So Mike Cagney will talk about, he lends both, uses Bitcoin as collateral and obviously home equity as collateral. And although rates for the Bitcoin lending are significantly higher than they are for the home lending, if you take out a HELOC or a mortgage, your Bitcoin loan will be 18%, 12%. Your HELOC might be 6 or 8%. Mike will argue that the Bitcoin is better collateral than a person's house because the Bitcoin trades 24/7, 365. You can lock in, you can liquidate at a certain LTV, whereas in a home, you're not liquidating a homeowner on a second lien mortgage easily. So he thinks the rates should obviously be inverse of where they are, and that's a market inefficiency that could be made significantly more efficient. Bitcoin rates arguably should be in line with home equity rates, if not lower. But you can't really enact that construct until you have all of a person's assets, all of the person's wealth, fully on chain in a marketplace construct with, very importantly, perfected ownership of assets. And this is something in private credit that nobody really talks about. In order for Figure to sell a loan to KKR, KKR has to own the loan under the UCC filing, has to have an asset perfected ownership. And in case Figure or the lender goes bankrupt 5 minutes after they bought it, KKR wants to be sure that they own the loan. And there aren't a lot of people thinking about that in the space. And until these basic blocking and tackling issues that you have in the real world are solved in DeFi, it's still a long way until we get there.
Yeah, and Anthony, you said that there. Everyone wants a single or consolidated digital interface to interact with all of their assets, I would say. And I think I don't want to butcher the number, but I think before the Bitcoin ETFs were approved, something like 94% of all crypto buying was millennials and Gen Z. And things move more digital, right? They're not going to move backwards. They're not going to get less digital as wealth transfers from the boomer side over to millennials, Gen Z, younger than that. I don't even know what the next one is. But it'll all be more and more digital. And the importance of having tokenized stocks, individual loans, Bitcoin, crypto generally, and other assets in one interface, unlocking it with the power of DeFi for kind of 24/7 access, let's call it, and real precise management is huge. And I think that's the real macro value driver that a lot of people kind of miss. They don't think about that. They think about products standalone, not the broader trend of, hey, every asset's going to get managed in this way, one way or another.
I'll just add the problem we have is both operational and UI UX. So from a UI UX perspective, crypto doesn't do a very good job on that yet. TradFi Web 2 does a much, much better job. But then operational, so even on a Robinhood platform, which is really great, you can't use your Bitcoin as collateral for your Apple stock and vice versa because they both trade and settle in different areas. Even when they do tokenized stock, it's going to be a digital twin of the actual DTC settling security. So you're still not going to get ownership perfection. The key is ownership. I can't stress this enough. The key is perfection of ownership of a digital asset. And if it's a digital twin, that's increasingly difficult. So we at Provenance and ProvLabs and Figure, we strive for digitally native loans. The HELOCs are completely digitally native. They don't exist in a lawyer's filing cabinet or on an exchange somewhere. So when you own that digital token, you actually own it. It's supported, all the offline documents are supported in a really great piece of technology called an encrypted object store. So 5 years from now, when you're buying that loan and you click on a place on the blockchain explorer, you can actually see the video of the homeowner signing his video notary session, for instance. And these are the kind of efficiencies that we can bring to these markets, but it takes a lot of work from an operational perspective to get there.
Gotcha, totally. And like I said before, we have a blend up on stage of crypto loans and kind of off-chain products on blockchain. But Sid, why don't you, I'm personally very curious about Syrup, about the progress you've made on the retail side. You got a $50 million allocation from Spark and Sky recently. What's up in that world? Why are they looking so heavily at crypto loans and yield?
So, just to unpack that a bit. So we have the Insto side of the business, and under the hood, all of our loans are institutional loans, but we have an Insto distribution side where you've got to be an accredited investor to access the yield product, and then we have a DeFi-facing product, or a DeFi-facing distribution channel, and that's what Peter was talking about. So we call it Syrup USDC, but it's available outside of the US, but it's been the fastest growing channel for us over the last 9 months because we've had partnerships with Pendle. So we integrate it with Pendle pools where folks could effectively speculate on the yield, and then got it onboarded with Morpho so you could use it as collateral, similar to what Anthony was talking about, except you're using your LP token, so representing a basket of loans, as collateral on Morpho. And then the biggest one, the biggest partnership we've had most recently has been Sky or Maker. So they've deployed now over 50 mil into the pool. And the interesting part for them, what do they get out of it? If you look at their business model, they have an immensely large balance sheet, so it's billions of dollars, and they have a liability side, which is they need to pay out interest on SUSDS, so the staked version of their token, which is like a staked version of their stablecoin, which is like a savings product. So what we're doing is we're helping them to earn the yield to pay out that savings rate. And they use us alongside other yield-bearing products So they have allocations to Athena, so they've got a basis trade. They also have T-bills through Centrifuge's Anemoy product. And then they have over-collateralized lending through Spark. And then they now have what I would call almost C-DeFi lending. We're one of the only platforms where we will do loans, one of the only on-chain platforms where we can do loans against native Bitcoin instead of a wrapped version of it. And so they like this as a kind of diversifying play that generally earns higher yields. So this partnership for us, we think it can grow to hundreds of millions of dollars just because of the size of their balance sheet. But for us, it gives us a foot in both the institutional world, where we speak with high net worths, hedge funds, and family offices, and they will deploy to us. But it gives us another business channel into the more DeFi native world, where we can have a retail depositor from Argentina or from Dubai or from Singapore or one of these other DeFi native users who wouldn't otherwise be able to access the onshore product that we have. And I think this is still important. It's still, even though a lot of these products are kind of institutional in nature, being able to reach retail has been a very important driver of Tether's growth. If you look at where most of their markets are around the world, it's very heavily represented in developing markets. So, yeah.
Awesome. And Sid, you said a couple things, and I know it seems like stablecoin growth underpins a lot of this. Is that fair to say?
Stablecoins, I would liken as the, to use an analogy, the stablecoins would be the water in a fishbowl. It sets the outer boundary, which all of our products, so everyone on stage, so whether it's Provenance and Figure or Centrifuge or Maple, we're kind of dependent and we're bounded by the circulating stablecoin supply, because we do all of our loans ultimately in stablecoins, but that kind of sets up the size of the digital economy, if you will. And so you've seen there was recently a paper published by Sidney, which made a prediction that they think there'll be $2 trillion worth of circulating stablecoins in the next few years. I think actually over 5 years that they will undershoot the mark. I think we get to $1 trillion relatively quickly, but then from there it'll go to multiple trillions much, much faster. It'll be like an S-curve. And I think the reason for this is, if you look at stablecoins, they allow for instant settlement anywhere in the world, and then they make it much easier to manage, in our case, a lending business, but also, HELOCs. It's much easier to track the movements of stablecoins, and also to market your products to people around the world and serve them 24/7 when you can operate with stablecoins rather than fiat. I mean, we are, only one anecdotal example, but the number of times that you might have your banking wires blocked or paused for a couple of days, customers hate that, and that will cost you deals. So using stablecoins gives you a much more reliable business foundation.
Yeah, totally. It's stablecoin is the onboarding tool, right? It's kind of as you said, the outside bound of what can be done. And for those following at home, everyone knows BlackRock's BUIDL now. We know some of the larger treasury funds. But there's also a bunch of these like almost feeder-esque stablecoin products launching. Athena launched, I think it's USTB.
Yeah,
USTB, lowercase b. Essentially, it's these stablecoin products can become their own qualified purchasers or high net worth individuals, quote unquote, because they have 5 million, 25 million of deposits, and they can then buy these institutional only treasury funds, and then they take the stablecoin and retail access to the stablecoin and goes out into DeFi, and it's like its own economy being built on the backs of these different layers of onboarding tools.
Yeah, it's like Mark Andreessen says there's two business models. You can either bundle stuff or unbundle it. Right. And in Ondo's case, they are unbundling the BUIDL BlackRock fund, because normally you can only put a minimum of 5 million in there, but they make it accessible to retail and other users.
Beautiful. Well, listen, we had the DeFi Vault panel yesterday, which was awesome. And John specifically, personally, I'm very curious about real-world assets in DeFi Vaults. I think it's kind of a rebranding in a way. It's a place to park your stablecoins. It's not a tokenized asset. It's a place to park your stablecoins and generate yield or get some new exposure with it. So do you want to talk a little about ERC 7540, about what Centrifuge is seeing, You have a number of partnerships with like Clearpool and Ocean on the report on the vault strategies. I would love to hear more.
Yeah. I think I'm not a very technical person, but like the 75/40 standard basically introduces asynchronous settlement. So what the founders of that, which our CTO was very involved in the standard, was trying to achieve there is like, how do we mimic products that are currently off-chain where you may want some space and time between settlement for certain credit funds or lockup periods or whatever it is. So that's kind of the 75/40 piece there. I think when you look at these different vaults and using collateral or tokenizing something and then being able to leverage it as collateral, it's what everyone's looking for. I think we get, like I said earlier, these submissions through our homepage, and everyone is, some random high net worth saying, hey, I have this real estate, I want to tokenize it and borrow against it. It's out there, all over the place. And so I think that it's definitely the end goal use case. I think there's extreme value in it. I think there's sometimes difficulty from like a regulatory perspective. For example, our treasury fund is out of the BVI. If you want to go ahead and pledge that fund as collateral somewhere, you need to literally sign a transfer form, signing over ownership of your shares in the fund to someone else. And so there's still a little bit of sticky areas with it that kind of slow things down, but I think we're certainly making progress and looking at different innovative products that allow us to do it in a more seamless way. And then just one other piece on the vaults, I think there are a lot of RWA vaults out there that are creating diversified baskets that are bundling things together. I think that's fine. Like, I think, when it's just treasuries out there, it's not necessarily that sexy. Once you start to introduce other products like tokenized ETFs or CLOs, you have HELOCs. Once you can actually create this truly diversified basket, that's when things get interesting.
And
Go ahead. I'm of two minds on vaults. I like the innovation. I think you can only do something like this in the crypto world, so it's cool from that perspective. I do think, present company accepted, vaults are getting out of hand a little bit, or they have the potential to get out of hand, and I think we're going to see, you heard it here first, probably not, something's going to blow up in the vault space at some point over the next couple of years because the underlying collateral isn't liquid, right? You have to have, most things going into vaults these days are NAV-based funds, and they're not liquid on purpose, and they're not tradable on purpose because you're going to have to go back to the GP in order to get the ability to change ownership. It's a matter of time before one of these vaults blows up and takes a lot of people down with it. Again, not saying, because we're looking at the structure as well. So I live in a glass house. I don't throw stones. It's important to do that. But it's a bit of regulatory arbitrage as well because securities in, non-securities out, right? So which is why BVI, and we're looking at BVI too. Again, glass houses, I'm not throwing stones. There's a bit of regulatory arbitrage in the mix and a bit of turning a security into a non-security in the mix as well, which isn't great. So just for all of those considering vaults or looking at vaults, just please be careful, do the right thing, KYC where you need to KYC, comply with regulations where you need to comply with regulations. The BMA, the Bermuda Monetary Authority, has a great structure. I know Mountain and others, Open Eden have done things there. But just watch that space. And then just I'll add on the stablecoins, I think the best stablecoin ever was launched 5 weeks ago. It's Figures Yields, YLDS, SEC registered, yielding stablecoin. The Genius and the Stable Acts are putting forth regulations to regulate non-yielding stablecoins in the US, which I think is great and absolutely is needed. But why would you have a non-yielding stablecoin when you could have a 4% yielding stablecoin that's available to the public in the US? This is what Yields does. It's the first ever SEC registered yielding stablecoin, available to banks, available to retail. And I think we're going to start to see it become more ubiquitous going forward, and I think it is the regulatory compliant model. Now going back to a vault, it's only available on the Provenance blockchain to KYC holders. What if we put that into a vault and called it wrapped yields and put it into a Bermuda BVI structure and made it available in DeFi? We can do all that, but is that regulatory arbitrage? Maybe, maybe not. We don't know the answer to that yet. But these are the things we're thinking through, and in TradFi, you don't have the opportunity to do this, right? Because of the way that financial rails are structured. In crypto, we do. So we have power, we have to be responsible. Please, responsibility. Please, responsibility.
And regarding the vaults blowing up, is that on the real-world asset vault side, like off-chain assets in vaults, or stablecoin or crypto-pegged vaults?
Think about what goes into a vault. So crypto-pegged vaults, first of all, what goes into the vault is generally hard to get price discovery on. It's either a private fund that has a NAV. The NAV is constructed by the GP. The GP doesn't allow change of ownership without going back through the GP. There's the PTP rules for funds in the US, you know this, that prohibit trading of Reg D funds. So the underlying collateral isn't great because it's not liquid and you can't change ownership of it. So when you put these things into a vault and then you put something liquid on the back of it, it's just non-liquid security plus liquid non-security has the potential for disaster.
And I don't want to pitch here, but that's like the thesis. I think if you have funds that have underlying loan or asset reporting in real time, that's something that will actually give the collateral some meaning, right? Instead of having a stale, outdated fund that reports quarterly. And agreed. I mean, crypto time is real time. So my whole thesis with Inveniam specifically is like, okay, if we can enable this real-time reporting, daily basis, 2-3 days a week, whatever, give them something more, at least on the off-chain side, it'll be a mega upgrade. And then it may even take a blend of what John was saying with the asynchronous vaults, like maybe it's a credit fund, a CRE product that doesn't have instant liquidity, but if we have a blended product with the Janus Henderson Treasury Fund, for example, that kind of takes a buffer out on redemptions. Like that's the style that vaults are going to grow into as real-world assets come in.
Well, I think it's fundamentally the same issue as like when you have, a private equity fund trades under an ETF ticker. You have a liquid liability side and then illiquid asset side. So I think vaults are still going to be around and they're still going to grow and proliferate. And in a sense, if you're like for somebody who's managing a vault, they're using it as a capital formation tool. And then a way to provide redemptions for their investors who want to get out, effectively. But I agree. Vaults are a tool, and like any tool, they have the potential to be used well or used in a risky sort of cavalier fashion. And so I think it's mostly going to be, down to like the jockey that's managing it.
Yeah. And so you guys have all had some success on the actual distribution side. There's meaningful capital in all of your respective platforms. It's an easy question. Like, what is the yield? What's necessary from the buy side that you guys see? Whether that's Web3 institutions, DAOs, it could be off-chain traditional asset managers looking at the HELOCs, for example, for the added bips within there from the savings on the Providence side. Like, talk to us about what the landscape looks like.
The buy side is the biggest issue in RWAs and tokenization of assets. So there's generally most of these products are issuer driven. There's somebody who's saying, I have real estate or loans or some other asset and I want to issue that into the market. There's rarely have I encountered investors who are saying, hey, I just really want to buy this stuff and I just need a tokenized version of it. So I think distribution has therefore had outsized importance in growing these products, and it's why we focused at Maple on you're effectively offering a fixed income or a yield product, which is where the yield is coming from Bitcoin-backed loans, because you couldn't call up Morgan Stanley or you couldn't call up your local Wall Street broker and buy that asset, whereas for a lot of the RWAs, there is a TradFi or traditional finance analog to that product that they can acquire from people other than you. And so it's very tough to then sell that product to that audience. And so I think that's why the biggest moves so far from traditional finance into the crypto space have been folks like Cantor Fitzgerald looking at doing Bitcoin-backed lending. It's unique. It's differentiated. They are not competing with a ton of their existing competitors for that product. And then I would say on the other side, you've seen a lot of the issuer-driven narrative has been because they want distribution for their existing products. So there was an idea that you would tokenize your private credit fund, put it on chain, and there was a marginal buyer who's just sitting in stablecoins. But from the numbers that we're seeing for those types of products, that thesis isn't really bearing out. And so I think they kind of have to rethink these RWA products to be more differentiated from what is kind of already available.
Yeah, I'd say, all of the capital that has been raised, or most of the capital that has been raised from your traditional RWAs, your tokenized assets, has been from on-chain capital allocators. And on-chain capital allocators are used to high yield and high liquidity because they're looking at these, Bitcoin, Ethereum, Solana, whatever it is, these actual individual individual assets. And if you've spent any time in the traditional finance space, you know that those things typically move in an inverse direction, right? If you have something that's higher yield, typically it's got lockups, it's closed end, it takes a little while to redeem, all of that. And so I think a lot of the on-chain allocators have run into this issue where they're like, okay, we could historically get double-digit returns based off of basis trades or more on-chain native assets. Now what do we do with these treasuries that are yielding, 4.5%? And so where we've kind of had some success and where we've focused on are the on-chain treasuries like MakerDAO, that they have, billions of dollars on their balance sheet. They don't want to off-ramp it into dollars and do something with it. They need to do something with it on-chain. And so that's kind of where we're sort of distributing into from like a tokenized treasury perspective, and then trying to figure out ways with our partner Janus Henderson and a couple of others, how we can offer these higher yielding products that still offer, significant liquidity that these partners are demanding.
Yeah, I would just say Wall Street's been trying to get a double-digit liquid yield forever and hasn't succeeded, right? It just doesn't exist in the real world without risk. Risk is inverse, and if you want low risk, you get low return. It's just a fact of life. Now, this is why things blow up in crypto, is because people are trying to give you a 12 yield with a daily liquidity. It just doesn't exist. I'm going to go back to the financial product needs to be cheaper, faster, and safer plus, right? Most of the things we're seeing in real world assets aren't cheaper, faster, and safer plus. If you think about custody, it's a lot more expensive in digital space than it is in the real world. Asset management fees for funds are more expensive in our space than they are in the real world. Most of the service providers are a fee on top in crypto on top of a fee that exists in the real world, and that's no way to scale an industry, right? It isn't. So I'm going to go back to digitally native. The asset needs to be digitally native. It exists only on blockchain. That way it can be cheaper, faster, and safer because you're cutting out intermediaries, you're cutting out operational flow, and you're cutting out time. And then you can think about the plus, and the plus is more distribution or using as collateral for something else. Most real-world assets don't meet that formula and are destined to struggle. I'm not going to say they're going to fail, but they're destined to struggle because of it. So we need to keep pushing towards digitally native, and private credit is absolutely the right industry to do digitally native things in. And the revolution comes asset class by asset class. It won't come all at once. Private credit is a massive space with lots of different asset classes, each with their own characteristics. And we'll see, loan pools of, auto and solar and private credit and personal credit, corporate loans, all sorts of home equity investments, first mortgages, Fannie and Freddie, the GSEs. It's all private credit, insurance. It's all coming, and it's all going to come in digitally native form, but it's going to take a decade.
Yeah, and all great intel, guys. And I think it's almost like a barbell approach with the on-chain allocators. What I'm thinking is just blockchain foundations and DAOs and formal treasuries of that way. If they want to hold growth assets, they're not going to buy tokenized pre-IPO shares, tokenized VC fund interest. They'll just hold their native token. It's a growth asset inherently, right? It's like it's a tech piece. But if they want to diversify their yield, map out their runway a little better with the billions they're sitting on, they may look at a good blend of treasuries, some higher 10% private credit asset, something non-crypto correlated, so that even when a bear market might come, you're not consistently pinned by crypto. What are your thoughts on that?
Well, I think you've kind of seen every flavor of DAO or on-chain balance sheet management put into place so far. So we've seen things like, remember Olympus? That was effectively like an on-chain venture fund. So it purchased a bunch of growth assets that were highly correlated. And then as for the idea of just holding your own token, a lot of treasuries, they have that inherent bias in their balance sheet, but they actually want to diversify away from it because otherwise the value, if their business is declining, the value of their treasury also declines. And so they want to try and offset that. I think one of the most interesting trends I've seen over the last few months has been the compression of spread between the on-chain yield or required return, i.e. the hurdle that folks like Maker and Sky need to hit, versus what's available in the real world. So if you look October-ish last year, Sky savings rate was something like 12%. If you look at where it is today, it's something like 4.5%. So that compression, T-bills were still 4.5 to 5 back then. That was a 7-point spread, and now it's closer to like half a percentage point. And so we've seen the yields on chain really compress, and with that, people are searching for other opportunities. Hence partnerships like ours and like Centrifuge. But I think it'll be interesting if we look out the rest of this year. If you do see yield cuts, which push up the price of risk-on assets, then the BTC basis, so the kind of the risk-free rate you can earn on chain will spike, and then you'll see on-chain yields really start to diverge from traditional finance, and so that'll be that'll be really interesting to watch, because we've seen them come much closer together. But if you see a rate cut and you see a bull market again, the two will totally diverge.
Yeah, and I mean, well said, definitely. I think these tokenized RWAs are fantastic for the balance sheet exactly for that, right? You have sort of these bull and bear markets in the crypto world, and a lot of these treasuries and foundations and all of that are holding all of these liquid assets, but they're very speculative in nature and they have extreme swings. And so this is the great way to, diversify away from that. And we do see treasuries now looking at kind of more innovative things like you had mentioned with Spark and what Sky's doing. So yeah, I think we're just going to continue to potentially slowly progress up the risk curve for assets that they're able to diversify into.
And Anthony, I'm interested, the buy side for the HELOCs, like once you tokenize them, is that off-chain, that's traditional financial players who are buying those?
So over the last several years, it was largely digital in, analog out, and analog out meaning an ABS issued by Goldman and JP, BNY being the indentured trustee. So Figure does pretty much one a month, AAA rated by DBRS Morningstar with the underlying assets, again, all digitally native. And those bonds sell quickly, but a $300 million ABS in Wall Street world is not a big deal. If that was sold on chain, the crypto press would go wild. But now, over the last couple of years, particularly with the yielding stablecoin yields, they're going digital in and digital out. So KKR is buying $20 million a month of digitally native HELOCs into a wallet. They're using the registry perfection. It's called DART, Digital Asset Registry Technologies. It listens to the chain. The second it goes from Figure's wallet to KKR's wallet, KKR owns it. The UCC is filed. Mike likes to talk. He used to send a portfolio of loans to Goldman every 5 days. They would review them. 5 days later, they come back and say, yeah, we'll put these into the warehouse. And now he sends them concurrently. As he's doing, he sends them 5 times a day. And because ownership is perfected, all the documentation is in there, they're warehousing these loans immediately, which gives them massive capacity to expand. So they're going to be at about $1 billion a month at the end of this year, which is just unheard of. So they're going to be, Figure will be putting more real-world assets on chain in a month than most of the rest of the RWA space does in a year, just because they found the niche, and they've also moving into first lien mortgages. Sixth Street has just put $200 million into a permanent capital vehicle that they're going to take on the GSEs, Fannie and Freddie, particularly as they're privatized, returned back into the public sector. These are the biggest, outside of FX, US home equity markets are the biggest capital markets there are. And if these are the ones that are blazing the path in real world assets, ProvLabs exists to help other asset issuers follow in these footsteps. I've been doing this for a long time. There's nothing like this in the space. This is the way to do it. Cheaper, faster, safer, plus. That's the formula. It's not hard, but it's a lot of operational. I spent 20 years at BNY Mellon. That's where I grew up. I'm a security servicing nerd at heart. I know how Wall Street works. I know how value gets from A to B. I know how risk and compliance and controls work. And if real world assets are going to scale, they need to follow that formula.
Amazing, guys. And listen, we got just about a minute left. Amazing insights here. I was going to ask something, given the digital in, digital out, and then digitally native ecosystem in general. Is interoperability super important to access your products, or is that kind of just like a nice to have?
I think that's all abstracted away within the next year. There'll be a settlement layer blockchain, which I think is going to be Provenance because of the way we're built. We're built specifically for financial services. We don't use smart contracts in the way that most other blockchains use them. But distribution is going to be multi-chain. I'm fine with that. settlement layer in one or a few places. I think like credit cards, custody bank networks, an oligopoly will evolve because of regulatory and security and operational issues. But then distribution will be wherever distribution wants. There's far too many L1s right now. And those will be consolidated, and the complexity needs to be abstracted away. Nobody who's buying a HELOC wants to deal with a wallet. They want an account, they want to log in. If it's an MPC account, great, but no one wants to do their keys, and it just doesn't fit into the way that Wall Street works right now. So all that needs to be, as I said, UI UX needs to be fixed massively in Web3, and we're going to get there.
All right. Any pending thoughts?
Yeah, I'll take the other side of that. I actually think the medium is the message, right? And a lot of us grow up using MetaMask and other wallets. I agree. I totally agree that the UX on a lot of it sucks, but I think if you're building the UX for the older, like the incumbent crowd, you're missing the newer people who are coming through. Like the people who are going to be portfolio managers at these firms in the next 10 years will have grown up using MetaMask and playing around on Curve and Uniswap. So I think interoperability is important. If we didn't have interoperability, we wouldn't have the capital that comes in through the DeFi channel, whether it's Pendle, Morpho, Maker/Sky. And so I think if you want to reach a global audience, and particularly from a nimble start, it's pretty important.
Awesome. Well, as everyone can see, there's a ton happening on the on-chain lending, private credit, and in-between side. Give a round of applause to the panelists here. Thanks so much, Sid, John, Anthony. We got one coming up right after this. Appreciate it.